Switch to gold standard could stabilize prices, Philadelphia Fed. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on a Wednesday afternoon. And interesting news that came out yesterday of something that was done last month, as apparently the Philadelphia Fed has actually been studying the gold standard and what impact that would have on pricing. So, going to take a look at that and also go through some gold and silver charts and a little bit of other news that has come out in the past couple of days. So, hope you're doing well out there. And with that said, let us dig in as we take a quick look at the pricing today. I'm recording right about noon Eastern on Wednesday, and we see not much movement in the silver market, still at 24.67. Gold up $11, and that's ahead of the April contract going into delivery tonight, which we'll see how those numbers come out and whether there is a substantial number of deliveries, especially with the registered inventory of gold on the lower side. I believe is now down under 8 million ounces in there. So it will be interesting to see what happens in this delivery period. But anyway, you see gold back up at 21.88 and still hanging pretty close to the $2,200 mark. And with that said, let us dig into the news of the Philadelphia Fed here. This came out on central banking. I know centralbanking.com. I know that's a site that everybody watching goes to and visits frequently. And they had this note out yesterday: switch to gold standard could stabilize prices. Philadelphia Fed. Long run price stability could be a key feature of the gold standard. Researchers from the Philadelphia Fed have found out. And turns out this was actually a report that was done back in February of this year. And here you can see from Philly Federal Reserve Bank, working paper research department. And we will take a look in here at some of the highlights. I'll also put the link to this in the description field below. It's interesting what they wrote, and you can take a look through that if you would like to. But a few of the things that popped up to mind here on the first page, introducing their study and the highlighted part: while the gold standard exposes the home country to short-term fluctuations in money prices and output caused by external shocks, it ensures the long-term price stability, as the quantity of money and prices only temporarily deviate from their steady state levels. I would say the main takeaway from all of this, to me, it's rather fascinating that we're in an era now where the Fed is doing research papers on a gold standard and how that would impact things. Obviously, in the past couple of years, going back to Bernanke and Jerome Powell, at least publicly indicating that they couldn't care less about gold. I don't know that the fact that they're doing this research paper means that this is explicitly about to put us back on a gold standard yet, especially when you think about the things that are happening around the world with the BRICS and seeing Putin put Russia on a temporary gold backing, follow the invasion in Ukraine a couple of years ago. So certainly a climate and culture where there's a lot more talk about gold being used as a store of value, as I think it's safe to say an increasing number of people becoming concerned about the supply of the US Treasury and also the inflation that is eating into that return, where many points in time you have a negative real yield. So again, I want to be careful how I phrase this. I'm not saying we're going back to a gold standard tomorrow or anything like that yet. Interesting, and I think that's a step forward to see that they are studying this. And correction, this came out in January, not February, but let us take a look at a few of the other highlights. Here they mention our results align with the empirical studies on the macroeconomic properties of the gold standard, comparing the classical gold standard with the post-war period. Bordeaux and Schwartz find that it is not clear that the classical gold standard delivered greater short-run price stability, but they unequivocally conclude that it delivered remarkable long-run stability in the prices compared with other regimes. And in the paper, they talk about how, based on exports and imports and money, that things can shift in the short term, yet their research found what certainly many people who are living with higher prices today have felt for a long time that without the gold standard, things eventually get out of check. And obviously, we have the track record of currencies throughout history going to zero. So this might not be new to many of the people watching this, but anyway, here they mention our analysis uncovers three crucial properties of the gold standard. First, the gold standard ensures long run price stability. The price level in the home country consistently converges to long run equilibrium. Inflation and deflation are merely temporary phenomena. Formerly, we established that the dynamic system under the gold standard behaves like a saddle. Price level in the home country acts as a jump variable, while the quantity of money in a country remains predetermined because it depends on the inflows and outflows of gold resulting from international trade. If the initial quantity of money is below the steady state level, the economy experiences temporary inflation as the quantity of money increases during the transition period. This price dynamic leads to a short-term surplus in exports, causing the home country to accumulate gold temporarily. Over time, the inflation rate decreases as the price level converges to its long-run value from below. So along the lines of what I was just saying, that their analysis concludes that you do have these factors that impact things in the short term, yet over the longer term, they found that gold still does ensure long-term price stability, which we see up here. And then one more note from their conclusion here. It's about a 50-page paper, and at the end, they mention, we have also demonstrated that achieving efficiency under the gold standard relies on international policy cooperation, which may pose political challenges. And certainly that makes enough sense. Although, just found that interesting that when you think about what is going on in the world, where a lot of countries are looking for an alternative, have expressed their desire to find an alternative. So perhaps that international policy cooperation is something that could be more feasible now than really at any other time in history. So again, I will leave the link to that in the description field below if you'd like to take a look through it. It was certainly interesting, and at least those were some of the highlights that they had in there. And fascinating that at the same time that's coming out, here was a note. This came out 2 days ago from Jan Nieuwenhuis, as the World Bank has just released a handbook for asset managers on how to invest in gold. And it mentions in the modern era, gold continues to play a critical role in the global financial system, serving as a hedge against inflation, a safe haven asset, and a reserve for central banks. Gold remains a crucial component of the global financial system and is likely to continue to play an essential role in the future. This coming from the World Bank. And I'm going to be going through that one. I'll come back next week with any highlights that I found there. And just interesting that you see the Fed talking about a gold standard. World Bank is publishing handbooks for asset managers on what to do with gold. So I think certainly a change in the climate. Again, I know a lot of the people watching this are aware that there's been a change in the climate of how people look at gold, yet just quite fascinating that we continue to see it more prominently invoked in some of the things that are going on. Here was another note. This came out last year, although Jan was mentioning how the Dutch central bank has looked at the possibility of a gold standard. And in the interview he cites here, this was from Ert Hoben, director of the financial markets for the Dutch National Bank. And here was one of the quotes that he had in this interview. If we ever unexpectedly have to create a new currency or systemic risk arises, public can have confidence in the Dutch National Bank because whatever money we issue, we can back it with the same value in gold. So article talks about some of the shifts and communication and perhaps coordination that's gone on among the various European central banks, and does not say that they've overtly say they've been considering going to the gold standard. I guess this was as close as they got. We can bring it back to the same value in gold, which would be a form of gold standard, yet different than what we hear, again, as I mentioned, where at least in the US, a lot of the central bankers talk about just their bafflement that anyone would care about gold or anything to do with it. And it'll be interesting couple of years to see where things go. I wonder what this all looks like 10 years from now as pressure on not just the US Treasury, but the treasuries around the globe, where we have debt loads that have skyrocketed. I believe I mentioned the other day how 10 of the 11 major central banks are now getting ready to cut interest rates this year, which probably is not going to help the inflation levels that we've been seeing. And we'll see how quickly that exacerbates pressure towards being forced to do something. If we ever unexpectedly have to create a new currency or systemic risk arises, certainly seems like we are headed down that path. So, note here from the Wall Street Journal. This was from a couple of weeks ago. What you need to know about gold's curious rally. And something that I mentioned before, where there was no specific Fed catalyst driving this one, and your Wall Street Journal mentions, but the magnitude of the move and gold's climb before that call for more explanation. This was on the 11th, really. Well, actually, that was after the rally towards 2200 had begun. I'd say the rally began in February 13th, picked up steam towards the end of March. And something they mentioned here, which so I've been thinking about what really has been causing this rally. Again, this was before the Fed said they were still doing 3 interest rate cuts and suggesting that we could see inflation at 2% even as soon as next year. But Wall Street Journal mentions part of the explanation is a sense of growing economic and geopolitical risks outside the US central bank, and the world began buying gold after the 2008 financial crisis, accelerated their purchases after Russia's invasion of Ukraine. That certainly has been the case. And I continue to wonder if some of this has to do with the potential, well, the assets that have been frozen from Russia, potentially sending them into Ukraine to fund their war efforts and rebuilding. And partly I mention that because here we had back on February 29th, Putin warns risk of nuclear war if West sends troops to Ukraine. And he's talked about how we could be on the verge of the World War III if that happens, which of course is not an ideal thing to be reading. Although, again, February 29th here, and then on March 19th, EU plans to send Russian frozen asset revenue to Ukraine Arms Fund, and followed by France preparing contingent of 2,000 troops to be sent to Ukraine. Again, not to take sides here. The whole thing seems quite unfortunate, but just you have Putin saying, watch out for nuclear threats or World War III if they send troops. And what do we see shortly after that? More escalation by the West of sending money, confiscated assets, and possibly troops. So, not headed in an ideal direction. And I continue to wonder if that's had a fair amount to do with the recent rally that we have seen. And so far, that rally not, well, has slowed down, I suppose, but still close to 2200 on the gold side. And think this is having a fair amount to do with that. And anyway, a few charts I wanted to get to before we wrap up for today. This was something that I've mentioned a couple of times, where if you look at the silver price, because obviously we hear a lot about silver as a hedge for inflation, yet has it kept up with inflation in the last couple of years, and it's still below the 1980 and 2011 highs. And I've been wondering if perhaps it's not necessarily that there's one way to look at it, but if you look at what happened in 1980 and 2011, where you certainly had times where there was concern about the structure of the financial system at those points, panic in the markets, also liquidity concerns, especially in 2011 with a short squeeze accounting for part of that rally after QE2 was launched. And I've wondered, well, if you look at silver, has it accounted for inflation? And perhaps what we saw in 1980 and 2011 are a preview of what could happen if the system doesn't stay intact. Because at both of those periods, yes, there was a lot of concern, but the actions that were taken, whether we agree with them or not, did allow the current system to continue functioning. So, either case, I was wondering how this would actually look as you charted it out. And thanks to the help of Dr. John Hartnett, who is a researcher over in Australia and has been doing some work, helped put together these charts for me. And this one, you see this going back to 1960, but what we did here is indexed the silver price, which back in 1964, as it was coming out of the coinage in the US, was $1.30. So we looked at what would happen if you took that $1.30, put it into silver, or if you just had indexed it to CPI. So whatever the CPI comes out and increasing that value. And here we see that obviously silver in the red line has gone up around $25 now. And the CPI, again, I'm not sure that that's the most accurate metric of the inflation that we're facing yet. CPI comes in from $1.30 in 1964 to just over $13 as of today, if you're basing that off of CPI. Other line here is M2, and you can see some correlation, silver in the red line versus the blue, which is CPI. You can see it's hovered around there, obviously spiked higher here, but silver has been outperforming the CPI metric. If you're inclined to think that it should be measuring M2, then certainly that would have it a bit undervalued. And according to what we have on the chart here, the M2 level would put us just under $70. But either case, I think this chart is helpful where if you're wondering if silver is serving its role as an inflation hedge, at least to the CPI, I think you could make a good case that it has been. If you're going to measure it against M2, then has not to this point, although we see during those spikes, it certainly outperformed quite a bit. And when we think about where things stand today, with all the dynamics previously discussed in today's show, certainly the idea that we could have, and I don't even know if you would need a full fracture in the debt markets or currency arrangement to get another spike like this. Certainly the potential for a short squeeze or liquidity issues or whatever the Fed does next could have an impact. Although, if we think about what would keep this line, the silver price, somewhat closer to the M2, you do also have the possibility whether if we do eventually go into a shortage or if there is a more overt backing, maybe not a backing, not the right word to use. Certainly, if that were the case and silver was formally reintroduced as money, whether in the US or elsewhere, that would have an impact. Yet, even if we see something like how countries are turning to gold as a store of value, obviously with the small size of the silver market, that's something that could impact the price quite a bit. Here was another one that John put together where looking at the debt in the blue line versus gold and silver, and you can see gold had a close correlation up until about 2011 when the gold price came down. And then, of course, over the past decade, you see that gold has lagged the US debt load, which has obviously, as you're well aware, been skyrocketing, and silver quite behind the debt. So if we did have a conversion of those, then certainly gold and silver some room to match what has been going on in the debt. And again, I mentioned that Dr. John Hartnett has helped with some of this research, and he also has a great site, which I will put the link to in the description field below. So, a couple things to read as you go about your day here today. And a few last final notes. I mentioned that the Indian silver imports have been quite high to start this year. See about 700 tons in January, and then that big number, which was almost about 2,200 tons in February. So 3,000 tons. And to put some of these in perspective, This February number was a monthly record, and at least at this current pace, again, we've seen that the numbers aren't very steady. They diverge quite a bit, but at least at this current pace of about 3,000 tons already in 2024, that would be a record. The current record is what we have of the 9,600 tons back in 2022, and now we're at 3,000 tons rather in 2024 after 2 months. So if that pace continued, then gee, that would be a lot of silver, and wonder how that would work out. But we'll keep an eye on those India numbers going forward. And certainly one of the main drivers, you had that, this comes out to about 304 million ounces, that figure back in 2022. So 3,000 times six, we could essentially double that 2022 figure if the current pace kept up for the whole year, which I am not suggesting that that will be the case, but just to put these in perspective. And then the final note before we wrap up today, we did have some news out from First Majestic as they've completed their mint that we talked about last year, as First Majestic wants to be selling more of their silver directly to public. And now the mint is 100% owned and operating, and vertically integrates the manufacturing plant for investment grade fine silver bullion from the First Majestic portfolio. And the first strike of products will include 1,000 1 kilogram bars, 2,500 10-ounce bars, and 5,000 5-ounce bars. And this falls in line with their goal to be selling over 10% of the company's silver production directly through their mint, which you can find online by going to the First Majestic Bullion store. And also one other note here is that they're currently seeking ISO 9001 certification, which would allow for its silver to be IRA eligible. So link to this one also in the description field below. And congratulations to First Majestic. I know they've been working on that for a while. We'll actually be catching up with Keith Newmeyer later this week. So we'll look forward to hearing more about that from him. Hope you're having a great day out there. Appreciate you tuning in as always, and we will see you again soon.